Okay. So good morning, everyone. My name is Anna Hughes. I'm the Director of Trust here at the Arc of Northern Virginia. We're glad to have you here today as Cortney Heykoop from Clover Wealth Strategies guides us through some really important information surrounding financial planning for individuals with special needs. Please note that all participants are muted for this presentation, but we welcome you entering questions into the Q&A chat box and we'll work to answer them at the end of today's presentation. However, for specific tax questions, please connect with your CPA or tax professional as we're not able to provide tax advice and the content today is for educational purposes only. Additionally, as a note, the webinar is being recorded and we will be sharing it on our YouTube channel later today. Thank you again for being here and the floor is yours, Cortney.
Thank you. Good morning, all. My name is Cortney Heykoop. Just to go ahead and tell you a little bit about myself. I am the owner of Clover Wealth Strategies. We're a financial planning firm here in Northern Virginia. We help clients across the country, and our primary focus is working with families who have special needs. When I re-entered the workforce after adopting Lily, you can see her there on the cover screen. She's now 19. So much bigger than in this picture. When I re-entered the workforce after the kids were little, I realized that there were not many me's in the world that helped families like mine. So that really became my mission to help families as they navigate their financial plan, the financial plan for their children, as well as the intricacies of Social Security and Medicaid and Medicare and waivers and all of that crazy stuff that we have to continue to deal with to help our kids. So I will, I do have a disclaimer. There we go. Today is for information purposes only. I am not a CPA. I'm not a tax professional. A lot of what I do as a financial planner overlaps in the legal and the accounting spheres. So we definitely want to take specific questions that we have to our tax professionals. But the purpose of today is to really kind of go over some topics that we need to consider and things we might need to, talk to our tax professional on. Hey, is this something I can take advantage of? Do I qualify for this? How do I need to use this to my advantage? That type of thing. So really the idea of today is to help educate you and also to kind of get the wheels rolling and giving you some ideas of things that may help you. As families with special needs, we really we fall into what they call the advanced planning strategies in the financial world. So focusing on your financial planning, your special needs planning. So people say to me, well, what is that? So that is how is Social Security plans, it's Medicare and Medicaid plans. It's really kind of digging into what benefits my child will have and how that is going to work into my financial plan and also my estate plan. And what we're going to focus on today is how that really goes into our tax strategies and our tax planning mode as well. The biggest thing I say to parents all the time is you need to put your air mask on first. Okay. So we're reminded of that every time we get on a plane, that in the case of an emergency, secure your air mask so you're better able to help the people around you. It's the same when it comes to a financial plan. A lot of times parents will come to me and say, I need to fund a special needs trust. Can you help me? Of course I can. My first question back to them is, tell me about your retirement. Right? Because I want to make sure that they're in the right place for their retirement. So they're going to be there to take care of their kids. Same thing happens when new parents reach out to me and they say, I want to start saving for college. And I say, well, are we fully funding retirement? Right? So same kind of idea. We need to be taking care of ourselves so that we can take care of our family. And as a special needs mom, I'll remind us all, not just on the financial side, but also on the overall health and wellness side too. Take a little time for yourself. so that we're better able to be there for our kids, right? I have to remind myself of that all the time. Okay, so what are some things we're going to talk about today? We're going to talk about different tax planning considerations. Just as a element of review, I'm going to discuss the difference between tax credits and tax deductions because they are different in how they impact your taxes. We're going to discuss how the Secure Act eliminated the stretch IRA and how that will impact your estate planning, how you want to set up your beneficiaries and things like that. We will discuss the benefits of 529 plans and ABLE accounts and how they can work together, how if you have one and you need to move it to the other, all of that, and the benefits from a tax perspective. I added attendant income on here, and that is mainly because that is the number one question I see on Facebook groups right now is, I'm a parent, I'm an attendant, how is this taxed? So we're going to discuss that as well as lodging agreements for your adult child. And then we're going to finish up with medical expenses and impairment-related work expenses. And then we'll open it up at the end for Q&A. So I know the chat is disabled, but you can put any questions you have into the Q&A box, and Anna will monitor those and at the end kind of compile them and go through some questions. But of course, at the end too, I will share my contact information. You are welcome to reach out to me for financial planning and questions related to today's presentation. All righty. So just a refresher, a tax deduction versus a tax credit. What is that? So we pay taxes on our adjusted gross income, right? So a tax deduction decreases our adjusted gross income. So if we made $50,000 of taxable income and we qualify for $3,000 in tax deductions, then we're really only taxed on $47,000 worth of income. A tax credit applies to your balance of income tax that you owe. So if you owe $10,000 and you have a $3,000 tax credit, you're only going to owe $7,000. And I just realized that's not the numbers in my example that is typed here, but the same idea, right? It decreases how much you actually owe. So a credit is worth more in the long run than a deduction, of course, but both of them are equally, or both are important in things that we want to take advantage of when we can. There are also two types of tax credits, refundable and non-refundable, meaning if you end up owing zero at the end of the year and you have a tax credit of, let's go back. If you owe $1,000 at the end of the year and you have a $1,500 non-refundable credit, then you end up owing nothing. If it was a $1,500 refundable credit, you would get a $500 refund. So it just really comes down to a deduction decreases your taxable income. Tax credits decrease the taxes that you owe. Okay. So what are some potential tax credits and deductions that we may want to look for? There is a tax credit for the elderly and disabled. So this would not be for the parents. This would be for the actual adult child if they're filing taxes, right? Where they will be able to get a tax credit for their disability. There's also an earned income tax credit. Taxpayers with disabilities can qualify for earned income credit if they have earned income that falls within certain limits. And those limits change each year. They change if you're married, if you're single. So those two tax credits really apply actually to your child, your adult child, not necessarily to you unless you yourself are disabled, okay? There is also child independent care tax credits. So definitely speak with your tax preparer as to, how you can claim those. And you're able to claim a disabled child past the age of maturity because they are disabled. Now, one question that comes up all the time surrounding this is, you can claim them if you are providing 50% or more of their support, okay? This calculation has nothing to do with the in-kind support for Social Security. Different calculations, different organizations, different sets of rules, okay? So the dependent care is going to take the cost of everything associated with them, not just their housing and board, not just room and board, everything. Cost of their TV, their phone, their clothing, their gifts, their anything you do to support your child. And I would say if any of us have an adult disabled child living in our house, chances are we are supporting more than 50%. But if they're working, depending upon their income, then that could change whether or not you can claim them as a dependent. So you definitely speak with your tax preparer on this. But a lot of times people will say, well, if I claim them as a dependent, then Social Security is going to reduce by a third. Like I said, different systems, different criterias, different sets of rules. Deductions for home improvement modifications. So home improvement modifications related to a disability, I should type that in here, can be deductible if you itemize. So what's an example of this? Putting a ramp on your home, having to widen doorways, having to raise or lower sinks, cabinets, that type of thing. Making your house accessible for your child or your adult child. Also medical and impairment related work expenses, and we're going to go into detail on those as well. Okay. All right, so this is one of my favorite topics. The Secure Act, which passed in the last few years, eliminates the stretch IRA. So what does that mean? Let's start there. Prior to the Secure Act, if I retired, no, let's change that. Prior to the Secure Act, if my mother passed away and she had an IRA that she left to me, my required minimum distributions would be based off of my age and would extend out over the course of my life. Hence, you were able to stretch those IRA distributions over a greater number of years, eliminating tax consequences, okay? So if my mother passed me an IRA and I stretched it, that was say $100,000, and I stretched it out over 20 years, that's only $5,000 of income that I'm paying taxes on per year. Now, if I have to take that over 10 years, I am now having to take $10,000 each year over the course of these 10 years, right? It has to be liquidated in 10 years. A lot of times, those inherited IRAs are larger than $100,000, and the people inheriting them are in their higher earning years, meaning most likely my mother's going to pass when I am older and I have a higher income, thus I'm paying more in taxes. Okay, so the whole idea of eliminating the stretch IRA for the government is a revenue stream, right? They're getting their taxes faster and potentially at a higher tax bracket if they're taxing it at, when I'm in my 50s, early 60s, making my highest salary, okay? The reason that I like talking about this in our world is because the rule is different if that inherited IRA is left to a qualified special needs trust, okay? By qualified, I mean it is written properly, okay? So if that special needs trust is written properly and is there for the benefit of your adult child, and the assets are left to the trust, it is now still able to be stretched over that beneficiary's lifetime. That makes the first line of my slide here, very important. Not all assets are now created equal. Okay. So if I leave a $500,000 IRA to my oldest child who does not have any disabilities, and maybe he inherits that when he's in his 50s and 60s, a larger portion, potentially 28% of that is going to go to taxes. Whereas if I leave that $500,000 IRA to my disabled adult child, that tax consequence could be significantly less. So yes, trusts are taxed at a higher tax bracket than individuals, but the trust also isn't taxed on that amount if it is dispersed. So it could have a much lower tax consequence if it is left to the special needs trust versus leaving it to my other child. So special needs trusts are treated differently than regular beneficiaries when it comes to inherited IRAs. So that makes parents have to then decide which asset they're giving to which child and in what percentage, right? So if a parent's goal is to leave everything 50-50, I don't want to leave 50% of the house and 50% of the IRA to each child. I may want to change those percentages and give more of the IRA, or give the IRA to the disabled child, give the house to the non-disabled child. Different strategies will come into play now because of this Secure Act change. Okay. So that is a huge discussion in not just estate planning as in setting up your wills, trusts, and all of that, but in determining your beneficiaries, right? Because think, IRAs and life insurance are not dictated by your will. They have stated beneficiaries. So those assets avoid probate. They avoid everything. They go immediately to whoever is listed as the beneficiary. So when you have an IRA, you should have primary and contingent beneficiaries listed, and you'll want to consider how you want those assets versus other assets distributed, because life insurance assets and IRA assets are going to have different tax consequences. Okay. Another topic that I love to discuss are ABLE accounts. So ABLE accounts, for those of you who are not familiar with them, think of them as 529 plans, but with disability instead of education. Okay. Now I say that, but you can use an ABLE account for education as well. They do have some tax benefits. The money inside an ABLE account, as well as a 529 plan, grow income tax free. There is a Virginia state tax deduction, and the amount of this deduction varies by state and varies by plan that you contribute to. So if you don't contribute to your state's plan or one of the plans that they sponsor, then you don't get the deduction, right? So a lot of times if you live in Virginia and you contribute to, say, T. Rowe Price, who is not the Virginia plan. Virginia has two plans, the Virginia State Plan and the American Funds College America Plan. If you don't contribute to those two, you don't get the state tax deduction. ABLE accounts have a $2,000 Virginia state tax deduction, not federal. Remember, the money grows federally tax-free. You don't get a federal deduction, but you do get a state tax deduction. On the 529 plan, you get a $4,000 deduction. Don't ask me why. You get more of a benefit for education than you do for disability, but that's the way the tax law is written. So that's the major benefit from a tax perspective for the ABLE accounts. One thing I always tell people if they say, should I open an ABLE, should I not? I always say yes, it's another tool in your pocket. It is not a replacement for estate planning, because if it goes over $100,000, Social Security will look at it as an asset. But it's a tool in your pocket, especially because there's currently a housing loophole. Special needs trusts can't pay for housing without hurting your Social Security excuse me, without hurting your Social Security eligibility. However, if you look at the qualified disability expenses, housing is listed there for an ABLE account. So as of right now, there's some definite benefits from that. 529 plans can fund, I'm sorry, special needs trusts can fund ABLE accounts. So it's a nice tool in your pocket. I have 529 plans on here because a lot of times families will say, should I do a 529? Should I do an ABLE? What should I do? It may be that you do both. It really depends on your child. It depends on where you are in the planning process, right? If you come to me and you have a 5-year-old and they are, placed on the autism spectrum, and we have no idea at 5 what college is going to look like, right? Even right now at 14, there's been so many changes to the programs that colleges offer for DD and ID kids that that may still be something that you want to consider. So having both 529 planned and an ABLE account is 100% okay. It could be a great strategy for you on the tax side because you can get deductions for funding 529 and for funding the ABLE accounts. And unused 529 can be rolled into the ABLE account. Now, one thing that is very different from a 529 to an ABLE account. Kids can have many 529s. I can have a 529 for my daughter. My husband can have a 529 for my daughter. My mother can have a 529, and aunt and uncle can have a 529. There can be numerous 529s out there. There can only be one ABLE. And this year it has an $18,000 limit. So if you're rolling from a 529 to an ABLE, you can only roll in that amount, that 18,000. Now, I say it has an $18,000 limit. If your child is working and they are below the poverty level, they can also contribute their earnings up to the amount of the poverty level into an ABLE account that year as well. So there are some circumstances you can go over that 18,000, and that 18,000 is the gifting limit of the year, right? So as that gifting limit changes, so will this. But there are a lot of strategies you can use with ABLE. From a tax perspective, you want to think you're going to get a $2,000 state tax deduction. You're going to get a money growing income tax free. And some people also use it as a way to give their kids some flexibility, because if you use the Virginia plan, they get a debit card and they can use the money that way. But you do have to be careful that it's only used for disability expenses. So that's a whole rabbit hole, whole presentation in and of itself, right? Okay, so taxation of attendant income for parents or siblings. And for siblings, I mean siblings that are living in the same household. So, for example, my daughter's 19. Her brother helps us out with respite when he comes home from college, right? So he lives within her household. So he has that tax benefit because this is his primary household, right? For the parents, this income is not federally taxed, okay? So if mom or dad, or brother or sister that lives in the same house as the disabled person is the attendant, that income is not federally taxed. So if you get a W-2, you, yes, show that to your accountant, but make sure they know that is not federally taxed. I should have put the name of the law here on it, but it's difficulty of care is the name of the IRS tax law that stipulates this. So if you want more information on it and you Google difficulty of care tax, it will come up. But I can also send you the link to that specific IRS publication. One kind of stipulation, and it has been asked of me as to why this is, and I don't know, and I haven't met anybody who actually knows the answer to this either. But say say dad's the attendant, mom's the employer of record. No federal taxes, no Social Security, FICA is taken out. If you're a single parent, you're the attendant, and your employer of record is a friend or relative that does not live in the house, Social Security and FICA, it's still deducted from your taxes or from your paychecks. I don't know why. You can see it listed on the application when you fill out to become an attendant. It's one of the boxes there, but I don't know why that is. I just know that it is. All right. Okay, lodging agreement. And this is very, very important. And it is something you definitely want to have a deep conversation with your accountant as to how you want to handle it. Because I have talked to accountants that have answered this very differently. Okay. A lodging agreement is important because if you are not charging your child for quote unquote rent, okay, and that is what Social Security will call it. They will call it rent. That's to cover room and board. Then they will reduce your Social Security income, or not yours, the child's Social Security income by a third. Okay. So you want to have a lodging agreement saying with your adult disabled child saying you are going to take this amount of money out of their account each month to cover room and board. Okay. If it's important because if you don't, your child's not going to receive as much of a benefit. A lot of parents will say to me, but I don't want that money. I don't want to take money from them. They only get $943 a month, right? Correct. That is all they get. But if you don't take it, they're going to get a lot less. So take it down, take a third off, 300 off, right? So then we're down into the 600 range. You can charge them that and then use that money for their benefit in other ways. Okay. And we'll get into that in a second. But the reason I say have a very deep conversation with your accountant on this is this lodging agreement is not really rent. Yes, that's what Social Security calls it. But again, Social Security and the IRS, different agencies, different verbs, different verbiage. Can't talk today. Different ways of stating things, right? The Social Security is calling it rent because that's what they need to call housing. IRS, if it is reimbursement, it is not taxable. So if you have mom, dad, and adult disabled child, 3 people living in the house, they can reimburse you a third of those housing expenses of the cost of the rent or the mortgage, the fair market value, the utilities, the grocery bills, all of that. So reimbursement is not taxable. So have this conversation with your accountant. And I have met accountants that are very, very, very conservative that are like, yeah, no, you need to charge that as income, right? And so then you need to have that discussion. Well, are you paying more on that rent in taxes than they are receiving an additional income by not getting the third reduced? Most of the accountants that I have worked with consider it reimbursement. And it's not a taxable event. But please have that conversation with your accountant and decide how you are going to move forward on that specific topic. And now I talked about use this money strategically if possible, because, sometimes as parents, especially if we have high medical bills and all of these things associated with taking care of our children, we need that money, that third that they're paying us, or that whatever that number is. Let's be honest. Fair market value for an apartment in Northern Virginia is more than the $943 that they receive. So whatever that amount is, 500, 800, whatever, that you're charging your child for lodging. You can then turn around, put this into the to enable account for them, put this into a special needs trust for them. Use this money to buy a life insurance policy that will put a lot more into the special needs trust when you die. I have a family right now that they're paying $800 a month, or they're paying $500 a month. Let's take that money, and how much life insurance can we get so that $1 million goes into the special needs trust when we die, or 500,000 goes into the special needs trust when we die. There are different strategies that you can use inside that special needs trust to boost how much money will be there for them later on. So be strategic with that money if you can. Okay, medical expenses. So you can deduct the cost of medical care and expenses for yourself, your spouse, and your dependents, meaning your adult disabled child, if you itemize. So if you take the standard deduction, a lot of these itemized deductions for work expenses, health expenses, things like that won't count. But if you itemize and your unreimbursed medical expenses exceed 7.5% of your adjusted gross income, that you can deduct. So if I make $100,000, my adjusted gross income is $100,000. If my medical expenses are $10,000, I have 7.5%, right? So 7,500 is not deductible. Anything above that 7.5 is a deductible expense. Okay. So in that case, if it was $10,000, 7,500 is not deductible. So 2,500 is deductible. So instead of having a adjusted gross income of $100,000, it is less 2,500. Okay. So we're now down to 97,500 of income that I'm going to be taxed on. You would be surprised how quickly these add up, okay? Especially when you have households like ours, right? So what are some of the things? And this is literally copied directly from the IRS publication, okay? Payments of fees to doctor, dentists, surgeons, chiropractors, psychiatrists, psychologists, and non-traditional medical practitioners. So acupuncture, trying to think of different therapies that could be listed here, right? But non-traditional medical practitioners is listed, and those typically aren't covered by our health insurance, so they're 100% out of pocket. So that will be in there. Payments for inpatient hospital care or residential nursing care if the availability of medical care is the principal reason for being in the nursing home. That will include the cost of meals, lodging charged by the hospital or home. Acupuncture, we already put that with the non-traditional. Amounts paid for inpatient treatment at a center for alcohol or drug addiction. Amounts paid for participation in a smoking cessation program or for prescriptions to eliminate nicotine withdrawal. Amounts paid to participants in a weight loss program. In limited situations, it can be paid, healthcare, health clubs can be covered. If it is for the purpose of preventing or alleviating obesity. Um, Insulin, prescription drugs, and medicine. Amounts paid for admission and transportation to a medical conference related to a chronic illness. That one is huge because that right there, if you go to a type of conference, specifically to a certain disease or illness that your child has, or say you have to go and stay out of town, for you're going to Charlottesville to stay near the hospital down there for a treatment program or to see a specialist, that all would be deductible. Amounts paid for false teeth, reading and prescription glasses, contact lenses, hearing aids, guide dog or service animal. Okay. This one put me over the limit or over the 7.5 for a few years, quite a few years. You saw in that very first introduction slide, my daughter had a service dog. She had an autism dog. This is not an emotional support dog, different. It has to be a service dog. So it's there for a specific disability, right? That dog is considered a medical device. So his food, his vet bills, his grooming, because he has to be kept nice and clean and pretty for being in public, all of that is considered then a medical expense and is deductible. Amounts paid for transportation for medical care. Like I said, if you have to go out of town to see a specialist or to get a second opinion at a hospital that's in another state, all of that transportation costs would be deductible as a medical expense. Amounts paid for transportation include your out-of-pocket expenses for personal cars such as gas, oil, or the standard mileage for medical expenses, plus the cost of tolls, parking, taxi, bus, train fare, ambulance costs, all of that. Amounts paid for insurance premiums to cover medical care or qualified long-term care. This is money you pay, not what is payable by your employer. So if your employer pays any portion of your premium, that is not covered. Also, if your premium is already deducted pre-tax from your income, you can't double count it here, okay? If you get any type of reimbursement, it can't be counted here. So this is for unreimbursed costs. Certain costs related to nutrition, wellness, and general health are considered medical expenses. The one that comes up all the time is specialty foods. For the most part, and vitamins, those are not. Unless it is tied to a prescription, and how it's billed and how it's paid for, there are some ways to get it in, but speak with your doctor and your tax professional on that, especially, I've had, for example, the medicine that goes into a feeding tube is deductible, but special food because of an allergy or an aversion to certain things is not. So there's some gray area in that, yes, but it gets very complicated. So work that specific nutrition stuff out with your tax professional. A couple things that are not deductible. A portion of your insurance premiums paid by your employer. Any medical expenses paid by the plan aren't deductible unless the premiums are not on your W-2s. So like I said, if it already has come out pre-tax, you can't deduct it again. Funeral and burial expenses, non-prescription medicine. So Advil, NyQuil, those are not deductible. Amounts paid for a trip or program for general improvement of your health. So you want to take a yoga retreat. That's not going to be covered. Amount paid for cosmetic surgery, not covered. Now somebody said to me, what about reconstruction after a breast exam or, breast cancer? That I believe is, but check with your attorney on that. Cosmetics, toiletries, toothpaste, that falls under that same, non-prescription medicines, right? Those are not deductible. Nicotine gum and patches that don't require a prescription are not covered. The ones required by a prescription are covered. So again, that's a situation where you want to talk to your doctor, right? If you're trying to quit smoking, talk to your doctor about getting the ones that are prescription based, because then that's tax deductible for you. So how do you keep track of this, right? One way to do it, usually you can get from your health insurance and dental providers, you can get a year-end statement that shows what you paid out of pocket for your copays and things like that. That's one way. All of the other things, you need to keep a spreadsheet and keep it going all year long whenever those items come up. You can have Google Sheets on your phone, enter it in, toss the receipt, keep a copy of the, sorry, don't toss the receipt, keep a copy of it. There's scanner apps that you can put on your phone. That's one thing that I do. I have a scanner app on my phone that has a folder for medical expenses. And anytime I get a receipt, I just take a picture with my phone and put it in that folder. And then, you can easily go through those receipts and create your spreadsheet, or keep your spreadsheet going at that time. So impairment related work expenses. I'm going to read this one. I'm going to move the picture of myself down here. Okay. Employee with impairment related work expenses. These are the allowable expenses of an individual with physical or mental disabilities for attendant care at his or her place of employment. They also include other expenses in connection with the place of employment that enable the employee to work. There's the publication that has more details from the IRS. It's publication 463. If you have a physical or mental disability that limits being employed and substantially limits one or more of your major life activities, such as performing manual tasks, walking, speaking, breathing, learning, or working, you can deduct your impairment-related work expenses. Impairment-related work expenses are ordinary and necessary business expenses for attendant care services at your place of employment and other expenses in conjunction with your place of work that are necessary for you to be able to work. So what is that? Adaptive equipment. It can be an attendant or a caretaker. An item or a service that enables you to work. Maybe you need to be able to work remotely because of your mobility. Then a homework computer or whatever would need to be purchased to set up that home office. An accessible vehicle. The only way you can get to work is with a vehicle that is accessible. That is an impairment-related work expense. Business expense paid that is unreimbursed by another source, such as Medicare, Medicaid, or private insurance. So if Medicaid pays for that attendant to come to work with you, you can't deduct that, right? So you need to be careful with that. But anything that you need, and again, discuss that specific item with your tax preparer, but that can be deducted as well. So the importance in all of what I'm saying here today is ongoing planning and checking in with these things is important. Having this tax discussion with a tax professional or financial planner now doesn't mean you're done forever. You need to evaluate all of these aspects: financial planning, estate planning, tax planning, and special needs planning on a yearly, or depending upon where you're at in your life, biannually, sometimes more frequently than that. It's none of these are one and done. You need to revisit estate planning documents. I highly advise people to look at them every 5 years at a minimum. Tax planning, financial planning, much more at least annually, because laws change, right? So things that we're talking about today might be completely different than before. Maybe you did your tax and estate planning prior to the Secure Act. Well, that might change now that the Secure Act has changed what happens to the stretch IRA. So this needs to be done on a continuous basis, right? Same thing with special needs planning. I have my fingers crossed and you know, sending all the good juju and prayers and everything I can that our legislation will be changed based on the Social Security disability income, kicking people off Medicaid because, their parents have retired and now they can get SSDI instead of SSI, but that will kick them off Medicaid eligibility. So I'm praying that that legislation is fixed. But if that changes and it is fixed, then that might change your planning for your child, right? So you need to constantly be looking at all of these factors and speaking with a professional. I'm gonna, before we go into questions, I'm gonna leave you guys with two quotes. My first quote, and it's one that hangs on the refrigerator in our house, and my kids will say, "I know, mom, fair is not equal." Um, because it's not, right? It's setting each person up for success. And as parents, especially when we have special needs kids and non, trying to figure out our estate planning and all of that is hard, because we want to be equal and we want to be fair, and figuring out what that looks like for your family is important, right? Um, so I want to put that up, this picture. Like I said, my kids roll their eyes at me now because I've been preaching that at them for so many years, Um, Not everyone got a cell phone at the exact same age, right? They got it when they needed it and when they were responsible enough to have it. So, just things like that will impact your estate planning. So keep that in mind um and make sure you're having those conversations with your loved ones. So here's one of my favorite financial planning quotes. Long-term thinking and planning enhances our short-term decision making. Make sure you have a plan of your life in your hand. That includes the financial plan and your mission. We can't get to where we're going without a roadmap of how to get there, right? So knowing where we want to be and will help us make the decisions necessary to get us to where we want to be and where we want our children to be as well. Um, so I will stop there. I'm a very fast talker, so I probably went through, oh no, 10:50. I timed that right. I timed that perfectly. Um, I will open it up to questions. It looks like, Anna, we have quite a few questions in the Q&A. If you want to start me off, I will go through those, and my contact information is on the screen here for you all. And we'll go from there.
That sounds great. So I was trying to keep tabs. I answered how many I could. And so I'll start from the top and we'll go from there. So the first question we had was, as a successor guardian, how do I check to see if a loved one's taxes have been addressed?
So you can receive a tax report from the IRS that will show if taxes have been filed. Now, as a successor guardian, or as you're now the guardian, right? You're going to have to provide that paperwork for them to be able to share that information with you. So I would start by calling the IRS. I know, not a fun. I think the only thing worse than calling the IRS is calling Social Security. But depending on where I'm at, some days I might say the reverse is true. But call Social Security and ask for a tax report. Um, depending upon if a IRS account was set up for them, like an electronic account, by the previous guardian, you may be able to access that electronically. Um, but you would have to know what the username and password is, and I'm not sure if that was shared or if it's even ever been set up. But that would be your first place to check.
Perfect. All
You
right.
know what? And can
Yeah,
I add on to there a second?
of course.
Um, so this brings up one of my biggest soapboxes, is making sure that the next person in line has all the information that they need. I'm offering a program this month. Well, actually, it's going to happen in March, but we advertised it yesterday on Valentine's Day. It's called The Family Love Letter, and it's literally a book that writes down, this is where my passwords are, this is where this is what you need to do for that. Everyone should be doing that type of love letter for whoever's going to come after them. And I think everybody needs that. Single women, single men, married couples, anybody who is going to or could potentially need to leave that information to somebody else. And when it comes to a special needs child, that's even more important, because we need to document things like what medications have worked, what procedures they've had, what doctors they go to, all of that, to make it easier for the guardian when they come along. So just my little soapbox, sorry.
No, no worries. I agree with it. So all good. So the next one would be, how do you find an accountant to do your taxes after you're no longer able to do so? My disabled daughter will need to have her own tax return done for as she works, and she's going to need one for her trust as well.
So finding tax attorney or tax preparers is not easy. There's definitely a shortage out there. I would ask around to your family and friends who they use. Um, I have a handful that I use as well, but you want to ask their experience with special needs trusts as well as disabled adult children, to make sure that they're going to know the specific intricacies of our situation. And one of the reasons that attendant care was a big screen on a whole screen or slide in the presentation today is that happened to me. First year, we got that W-2 and we're like, oh my gosh, they didn't take any taxes out. We ended up having a huge tax bill. Then I found out, oh wait, it's not taxable, and had to file, amendments, and it was a whole mess. So, making sure that your accountant knows, and they don't make those types of mistakes.
Our website also has a directory as well, and so that's a place I would also recommend. Just peeking and seeing what we've listed out too. Okay, so then the next one, this is more of a statement. Just checking, a tax deduction is an adjustment to adjusted gross income, but a tax credit is a deduction in any tax still owed. Does that sound right?
Yes.
Perfect.
So
Okay.
the tax credit is a deduction from your bill. A tax deduction is a deduction to your adjusted gross income, your taxable income.
Perfect. All right. How much do I need to make to do child tax credits?
I do not know that off the top of my head. There is a chart on the IRS website. If you look up adjusted tax credits, or child tax credits, I mean, of how much you need to make and how much it phases out at higher income levels as well. But that is not something I commit to memory, sorry.
Good to go. So the next one is, I believe they're referencing, can the Autism Society of Northern Virginia recommend a tax advisor for repairing past tax issues of the beneficiary or a lawyer for a trustee transfer or POA? I don't know if ASNV can do so. I would again, just jumping in, we have our provider directory. So if they're looking for a tax specialist, that would be a place to check. And then Courtney, if you have anything else to add to that.
Yeah, no, and I know that the ARC in Northern Virginia also works with a variety of different lawyers that know the special needs trust world very well. Um, I have like my 3 to 5 favorites that I work with as well. And I'm glad to provide that. I do have that on my website as well, but I know the ARC of Nova's website has great listings there.
Yep, indeed. Okay, so then we've got, are Roth and traditional IRAs treated the same under liquidation requirement?
Yes and no. So, the Roth doesn't have a taxable consequence, right? So that money passes income tax free regardless of when it is taken out. You do have to liquidate it within a certain amount of time. However, you don't have a tax consequence for it, so it's not it's not a detriment, right? Where the traditional IRAs have not been taxed before. So any money, 100% of the money taken out of a traditional IRA is income taxed.
Perfect. All right. So next, can you roll over the IRA into IRA without taxes, or is that just for spouses?
That's just for spouses. So when you have a 401k, for example, that can go to a spouse, right? Or if you have an IRA, that can go to a spouse. It becomes an inherited IRA when it's a non-spouse, okay? And depending upon your current retirement account, that can, and I'll mention that in this area specifically because we have a lot of government employees, right? Your TSP, it can go to a spouse, not a problem. If it is not, say my husband, he's a federal employee. I pass away. So now his TSP needs to go to our contingent beneficiaries or our children. It does not go into an inherited IRA. It is 100% liquidated immediately. So he would need to, once I pass away, roll that into an IRA so that it can become an inherited IRA. Because if our children inherit a $500,000 TSP, that is taxable in 1 year at $500,000 of income, plus whatever they made that year on their own, right? So huge tax consequences for that. I think I saw that down there a little bit lower as a TSP question. So yes, TSP that there is not a spouse for needs to be put into a rollover IRA. And honestly, that's the only time I really ever advise, maybe there's others, but that's the only one I can think of right now, to move TSP money out of the TSP, because the TSP is the cheapest, best retirement vehicle out there, except when it comes to certain estate planning factors, right? So if a spouse is not there to inherit that money, put it into a rollover IRA so that it can become an inherited IRA.
Perfect. Okay. Uh, so I did dismiss that TSP question because I know you just answered it.
Thank
So we'll
you.
keep going. Yep, absolutely. So the next one would be, does the distribution exception qualify with other trusts or only special needs trusts?
So there are many different rules for different types of trusts, and some of them have to be liquidated in 5 years versus 10 years. So it is very important that you look at the type of trust you have and have that conversation with your lawyer and your tax professional, because depending upon the trust, even a special needs trust that isn't worded properly, can have some issues. So you want to make sure that in the light of the new Secure Act, you have established things correctly. So yes, that's Kathy, that's kind of vague on my part, but there are so many different types of trusts out there. And really that stretch IRA is limited to very, very few, the special needs trust being one of them, that can be stretched. Most of them cannot be. Okay.
All right, so the next one, does the Able America plan have different tax rules than the standard dividend and interest income annual taxes?
Yes, it's not taxed. That standard dividend and interest earned or growth earned inside Enable is not federally taxed. It works very much like a Roth or a 529. It grows income tax free.
And piggybacking on that one, so also on the Able America plan, does that also have a housing loophole? FYI, I've been told you cannot have both Able 529 account and Able America account.
I'm confused as to what you are asking about the Able America plan. So in the state of Virginia, we use either Able through College America, through American funds, or the Virginia Able plan. So I'm not sure. I'm not really sure what she's referencing there. But Elaine, if you would like to reach out to me via email or phone after the meeting, we can discuss further. Because you can't have two Able accounts, but I don't know what you mean by Able, comma 529, or in parentheses 529. You can only have one Able account. But you can have 529 and Able accounts. So that's I just don't understand what exactly she's meaning there. Sorry.
Okay. So we'll go on to the next one. Is the ARC or any other organization promoting legislation that would allow parents to transfer money from an IRA to a special needs trust tax-free or at a reduced tax rate? That's it's a great question for the ARC. I can look into it and get back to you if you'd like to send me an email. And I can look into that question, at least on behalf of the ARC, and their promotion.
Yeah,
I don't know.
I will add that that Able or 529 plans can be rolled now to Roth or to Enable account without a tax consequence. But I have not seen any legislation about special needs trusts that at the federal level, but I don't know what the ARC is working on. Just what I've read, I haven't seen anything.
I haven't either, but I'll look into it. We'll see what I can find. So, that's that one. Limit for deposits into Able accounts.
Yes, so limits, you have the $18,000 per year. That's the 2024 gifting limit, right? So as that limit changes year to year, that number can go up. If the disabled person is working and they're below the poverty level, they can add money additionally into there. Okay. So something to think about. And this is what I did with my daughter. She's 19 now. She's working. If she contributes to her retirement plan at work, that's considered an asset, right? And she will not be able to potentially qualify for Medicaid or Social Security if she's over that $2,000 asset limit. So having a 401k isn't really helpful. However, I also want her to be saving for retirement because we all know living off Social Security is not enough money. So she contributes to the ABLE account instead of a 401k. And she's able to do that above that $18,000. Say if I or grandma or anybody else contributes $18,000 this year, she can still go above that up to the poverty limit. There is a big legislative push, I know, to get that changed, to have retirement money not counted as an asset, which I think would be huge in the move to, encourage work and independence, without potentially limiting the supports that someone needs to be able to work, right? So that's another whole soapbox, though.
Thanks, Courtney. So the next one, for the assets distributed from an inherited IRA to a special needs trust, is it taxed at beneficiary's ordinary income rate or at the higher trust rate?
Okay. Please double check this with your accountant. But what my understanding is say $10,000 is distributed from the inherited IRA to the special needs trust, and $9,000 is distributed to that person that year, then only 1,000 would be taxed at the trust's tax rate, is what has been explained to me. Now, I have also been told that depending upon how a special needs trust is written will determine how money is potentially taxed, if it's at the beneficiary's ordinary income or if it is at a higher trust rate. So double check that with your tax preparer. But from my understanding, you're only going to be dealing with the difference in what is dispersed versus what is brought in. So if it is all dispersed, then there would not be a taxable consequence there.
Okay. What is attendant income?
Okay, so if you have a child on a Medicaid waiver program and they get attendant care, that is a caregiver that is there to help them function in daily life, help with the activities of daily living, keep them engaged in the community, all of that. That person, say you get 40 hours a week or 35 hours a week or whatever. If the disabled person is over the age of 18, parents can be and always have been able to be the attendant. Under the age of 18, parents were not able to be the attendant until COVID. Over COVID, the law changed to allow parents to be the attendants, and then that emergency order passed or ended, and new legislation was introduced where parents can now be the attendant for minor children if certain criteria is met. Okay. That main criteria is that no other attendant can be found, and you have actively looked for another attendant, and that attendant cannot also be the employer of record. So the employer of record is the person that kind of oversees that attendant. So that is what the attendant income is if you as the parent or maybe one of your other children are the attendant. That's what we were referring to.
And just to jump in on that, for the adults as well, you still have to have very clear written justification to why a parent is the best suited for providing caregiving to an adult child. So, all right.
Thank you.
Yeah, absolutely. So the next one is the 2,000 credit for 529 per child.
So for a 529, you actually get a $4,000 state tax deduction. Don't ask me why. As a disabled person, you get less than makes no sense to me. It should be equal, but another soapbox. For a 529, you get $4,000 per parent, per child, per account. So I would have to have an account. My husband would have to be able to have an account. We would each have to contribute $4,000 into that child's account to then get an $8,000 tax deduction. Okay, and it's a deduction, not a credit.
So next one, is attendant care state taxable?
I believe it is, but I'm not 100% sure on that.
Is it VA taxes exempt?
I'm assuming they're talking about the attendant care since they were right after each other. Um, but I'm not sure which Mary is referring to there.
Okay. So we've got Liz's. Isn't there another difference between ABLE and 529s? ABLE has to be opened under the name of the beneficiary, unlike 529 is opened and controlled by parents or anyone who sets up for named beneficiary.
Yes. So yes, there's actually a lot of differences between 529 and ABLE. I noted a couple today, but yes, ABLE accounts are like I said, you can only have one ABLE account, and that is tied to the dependent or the disabled beneficiary's name, right? So that is my daughter's account. Now, depending upon that disabled adult, they can have control over that account or not, right? So even though my daughter is 19 now, I still control that account because she doesn't have that capacity, right? So I am the custodian, and I can name a successor custodian to help, her with administering that account. But there is only one account, and it's only $18,000 per account, not per person who wants to put the money in, right? So I can't put in 18,000, my mom can't put in 18,000, dad can't put in $18,000, but anybody can put money into her ABLE account, right? 529s are different in that that is an asset of the parent, and they can change the beneficiary, right? So I can have 529 plans for my 3 kids, or I can have one and change a beneficiary halfway through to my second child, right? You can change a beneficiary one time a year. And that money is considered the asset of the parents, right? And ABLE is considered the asset of the disabled person. So that's why you need to keep it under $100,000 so that it doesn't count as an asset for Social Security and Medicaid.
Okay. So the next one is lodging agreement. If parent is guardian, is it appropriate to have a lodging agreement? Child isn't able to make their own. Is it appropriate to have them a party to an agreement?
Um, I mean, I have seen many cases where the parent is the guardian and there's a lodging agreement. I think that, as long as it is appropriate and fair, I don't think anyone's going to question that. Um,
I'm echoing that. I've seen it
yeah,
before in my previous position. I see a lot of times where the guardian is able to enter into a lodging or rental agreement. So,
yeah, even if that agreement is with themselves. Yeah,
Mhm.
I would just be careful that it's fair and appropriate, right?
100%.
If it is above the fair market value, or if you're adding in for reimbursement of something that could be deemed questionable, maybe get an attorney that could, serve as a second set of eyes, or, a guardian ad litem or something like that. But I don't, I see it all the time. I mean, most of my clients, are guardians or conservators. So I don't see it really as a huge problem.
All right. So the next one, can you use the reimbursement money to fund ABLE account?
Reimbursement money. I think they're talking about the lodging agreement,
I
and
do
yes, you
too.
can. Yes, but that money, so if they're reimbursing you, right, then that money, that's say $500 a month, it seems to be what everybody uses, right? But that $500 a month, you can then put in on your behalf into the ABLE account, but it needs to flow through you. You need to have that money trail, right? So that money needs to go into your checking account. So say from their Social Security rep payee account. you take out $500 a month, you put it into your checking account, then your checking account can then fund the ABLE account. And you can set that up all automatic, every month the transfer can go from rep payee into your account. It hits on the 10th, maybe on the 12th, you have ABLE come and auto deduct it out into the ABLE account, right?
Does lodging agreement apply to SSDI, which is what my son receives?
So, Anna, correct me if I'm wrong, but SSDI is not impacted by in-kind support.
Correct. So SSI is the three main characters. It's the clothing, shelter, and food. SSDI does not have the same.
Correct. That was my understanding as well.
Right. So I believe. Yep, we kind of answered this already, which is the rent would need to go to the person that's receiving the rent and then can be gifted to the ABLE from the person, correct?
Yes.
Because if it's going directly from the beneficiary into the ABLE account, then it looks like a saving instead of a payment.
Correct.
Great.
Needs to flow through.
SSDI rules are different than SSI rules with regard to using special needs trust money for housing and other issues. Should be clear on this, even if you want to focus only on SSI. Correct.
Yes, SSDI is different than SSI. For sure, there's a lot of differences that go into that. I'm wanting. I don't know where that came up in the conversation, but
I think it might have been going back to the lodging rules and SSI and how it's intended to pay for rent.
Yeah. And the reason I highlighted SSI is that's the one it impacts, right? So does this include medical premiums?
I'm not sure where that was around the lodging conversation, but might have been right to the transition.
It may have been in regards to, whether or not you are when we discussed, if you are supporting your child 50%, I'm thinking that might be, and yes, anything you pay for their medical premiums would be considered support in that regard for being an IRS dependent. I don't know what, but please feel free to email me, Diana, after, and we can discuss further.
Okay. More specifically, difficulty of care payments are not federally taxed. Are the not VA taxed as well? Thanks.
I think we answered that one already. I believe they are Virginia taxed. Yes.
Okay. Will purchasing a life insurance policy for my son diagnosed after the purchase affect his eligibility for Medicaid, considering it's intended for his family members upon his passing?
Okay, so purchasing a life insurance policy for his son. He was diagnosed after it was purchased. So he is the insured, but he is not the owner or the beneficiary, so would not have any eligibility on his Medicaid, if I'm reading that correctly.
I'm also with you on that one, Cortney.
What is the name of the trust that insures funds from the life insurance policy won't revert to Medicaid if my son passes away? So there's two types of special needs trusts, a first party and a third party. Third party is money from the family. It's from a third party, right? To the disabled person. That, if a life insurance goes into a third party special needs trust, it is not Medicaid pay or clawback, right? There's no Medicaid clawback. If it is a first party trust, so if that life insurance policy he himself was the beneficiary of, and then we quickly put that into a first party trust, that is subject to Medicaid repayment. Okay, so if it's his money, then yes, it's subject to repayment. But third party trust, no. So you want,
and if you're planning, yeah, I was going to say, if you're planning in advance, you can certainly set it up through the third party and it is not subject to the Medicaid lien.
Yep.
Is COBRA a medical expense?
Yes, if it's not reimbursed and it's post-tax money, so yes, it would be a medical expense.
Perfect. Do any of that litany of deductions mean anything if we cannot itemize?
Well, anyone can itemize. It's just a matter of whether itemizing gives you more of a benefit than the standard deduction, right? So if you have enough items to itemize that gives you more of a deduction than the standard deduction, yes, it means something, right? So I track those things every year, right? Some years I can get a medical deduction, some years I can't, right? As a small business owner, I always end up itemizing anyway. But some people don't itemize because the standard deduction is more the than you would get if you itemize. So you would take the standard deduction. Okay. Um, did did I say that in a way that made sense?
I followed, so I hope
Okay.
so.
All right, good.
All right, so the next one, does itemization of some of these items tend to trigger more audits in your experience?
That would be a question for your accountant, but I think that if you itemize and you're doing it correctly, doesn't matter if you're audited because you're doing it correctly, right? So uh, I I never dissuade people from taking deductions that they're due because they're afraid of an audit. You know, we adopted one of our children, and that has a huge tax credit that you receive for going through adoptions. And I was told, "Oh, you will get audited that year, right? Because of this tax credit." And we weren't, you know, but I mean, I was afraid going in because if you get this tax deduction, people were telling me I would be audited. We weren't. Um, so, I'm a big proponent of using the tax law to your fullest benefit. Don't cross from a gray line to a black line, right? Like don't cross the line into something that's not right. But if it is something you are due to receive as a deduction or a credit, take it. That's why it's there.
All right, we do have about 6 minutes left, so we'll try to get through as many as we can. And Courtney, if you'd like, I can maybe compile the remaining questions and we can work to get those out at a later time. So we'll keep going. So where can we get more information regarding the tax credit for the elderly and disabled? As you mentioned, that for those on SSDI, but there's restrictive income limits. Anyone on SSDI probably receives too much. Thanks.
Yeah, depends on the parent's work history. If they're on SSDI under the parent's work history, it could limit them. But if you Google IRS tax credit for the elderly and disabled, I think the IRS's website is very clear. It has a chart on there that'll show you all those income limits and everything. But also speak with your tax preparer. They'll be able to be the best ones to do that. I do have the questions up now, Anna. What expenses are included in the lodging agreement? And so, I mean, you can Google quite a few of them, but really it's groceries, utilities, and the housing portion. So a third of the mortgage or a third of the rent. Co-pays for medical appointments and prescriptions for a disabled adult deductible. Yes. Yes, yes, yes. Cost of a job coach as distinguished from an attendant be treated as an impairment-related work expense. I believe so. Double check that with your CPA, but that is usually something that is needed to be able to do the job. Also check through DARS because that job coach may be able to be provided under your Medicaid. And Anna, as a previous case manager, you probably have more information on that.
I would also recommend going back to DARS because that is an expense that they should likely be covering. And if not, if you do have a waiver, normally they'll connect through DARS first and then it can go over to the waiver. So that would be my guidance as well. And also speaking with your support coordinator. All right.
Impairment-related work expense, that's for whoever's disabled. So whoever needs that impairment work expense, right? So if you need accommodation so you can be home to take care of your child, that's not going to fly because you're not disabled. But if it's, if you're disabled and you need the impairment modification or something like that, that is deductible.
Okay.
If you claim your disabled child on your tax return, does their deductions go on your tax return? So their medical expenses, yes, would go on your tax returns. I'm thinking that's what they're asking. But if they do not claim their own taxes, they might not be able to get that the disabled tax credit, for example. So but just because they file their own taxes doesn't also mean that you cannot claim them as a dependent. They can file their taxes saying somebody else claims me as a dependent. But speak with your attorney on that. But when you're looking at those like medical deductions and your child is a disabled adult dependent on your taxes, that is all under the household medical expenses. Yes. I'm pretty sure that's what you're meaning there. Can you combine the Virginia tax deductions for ABLE and 529 to max out $6,000 annually? Yes, 100%. What are the advantages of funding your special needs trust now rather than after you die? So that's very case specific, right? So a lot of times special needs trusts are not funded until after we die. However, if money is left from grandma or grandpa or something like that, then yes, they could be funded while you're alive. Also, if you're trying to gift money to lower your estate and you're trying to get money out of your estate for estate tax purposes, that could be an advantage. Here in Virginia, we don't have state to state taxes, and the federal estate limit is so high right now that I don't see a lot of people doing that right now. But if that law changes, that could come back into play. Pending legislation that would eliminate getting kicked off Medicaid when eligible for disabled adult child SSDI and income goes too high. Yes, there's actually Teresa Champion is working on that. She's championing that through an organization called Autism Outreach. They're working on that. I believe the ARC of Nova is working on that as well. There are a couple different bills in the Virginia State Legislative right now on that.
This will likely be our last one, and then Courtney,
Okay.
you and I can touch base on the other pieces.
Thank you, Doug. I see you there. Hi. SSDI says you need to pay Medicaid monthly copays if you make more than $1,300, even though you can make $2,500. Numbers may be old, but what is the copay? Is it just for adults? Anna, you might know that more than I do. I do know that there is a sliding scale, but I don't know what those numbers are. So if you're on SSI, you automatically qualify for Medicaid. But if you're on SSDI and you make more than the SSI, it can kick you off Medicaid. So you have to qualify for Medicaid in another way, and that may require a premium or a copay, correct?
So my recommendation when it comes to like the nitty gritty questions about SSDI and SSI, and you have Medicaid, I often encourage people to reach out to the Independence Center of Virginia. They offer benefits counseling if you do have Medicaid. And so that would be my first recommendation, to go check them out, see if they can help. And if not, Kim, I would recommend sending me an email and maybe we can set up a time where we can connect and talk through this question a bit more. All right. Well, I'm going to stop. I will copy paste all the remaining questions and see if we can get to them. But thank you all for joining us. We really, really appreciate your time and hope to see you again in another webinar. And I hope that you reach out to Cortney should you have any questions or would like some support with financial planning in the future.
Great. Thank you all very much for coming today.
Take care.